very different from, the 2007 credit issues and leverage issues that we had in the financial system, in a system that was, for the most part, overextended in terms of the amount of exposure they have to the different securitized markets, that created, quite a bit of a big mammoth that ended up unwinding. Today, what we're seeing is really more close to what we saw in the 80s, Tom, where it is oil shock, where we see oil prices over $110, and the inflation expectations and inflation concerns globally seem to be driving a lot of these pressure on yields. Now, the biggest difference, tends to be that, at this moment, inflation expectations and growth in the U.S. economy and global growth seem to be tied together. So a lot of what we see the yields pushing up on the long end seems to be as a result of, inflation expectations going higher, actual real economic growth to also go up, and the risk associated with deficit in all governments. So when you put all the pieces together, clearly we see that long end of the yield curve, moving much higher.
So, Omar, I mean, we've got the 10-year now at 465, up another 6 basis points today. I mean, where do you think this thing maybe ends the year? Higher or lower from here, do you think?
Well, we believe that, we're probably going to go back not too far from where we started the year. A lot of what these suggest is that 10-year yield benchmark seemed to be, a good balance between economic growth, inflation that we hope at some point after the conflict goes away that it will start to tame down, and economic growth. So I think when you put all the pieces together, we think it's going to probably end up appreciating a little more. We probably still need to see the highest on the yields, so we're probably going to see a little more spike on yields as we continue to see volatility and as we continue to see inflation, pressure. But overall, as things start to calm down and go back to normal, we're probably going to see a little bit more stability on inflation that would lead into a more increase in prices for bonds and lower yields.
I mean, Omar, I know you're hiring a new regime. You got Colin Martin coming in at Schwab. You got Kevin Gordon, who's there as well. What do you say to the young Turks that have never enjoyed price down, yield up?
Actually, that has been the story of my last decade, Tom, of trying to explain what high inflation means, because even at this level, if you go back to the 80s, this is really not that big of an inflation shock that we have. Clearly, prices at the pump are very high compared to anything we had back then, but certainly a lot of this has to do with just understanding the dynamics of the yield curve, the level of interest rates, as well as just where we are on the market.
Right.
And I think, the equity market is a great barometer for inflation. And we have been talking to our team here that the best hedge for inflation continues to be the equity market.